Microsoft is not just a software company. It is an ecosystem, a cloud infrastructure, a productivity platform, and now an AI powerhouse. Unlike many tech stories, Microsoft exemplifies the principles of long-term investing, durable competitive advantages, recurring cash flow, disciplined capital allocation, and patient growth. To understand why Microsoft has become a core holding for thoughtful investors, we must analyze its history, business model, financials, and strategic positioning in detail. Microsoft was founded in 1975 by Bill Gates and Paul Allen. Their vision was deceptively simple: put a computer on every desk and in every home. The company's first major success came from MS-DOS, an operating system licensed to IBM that became the industry standard. This early success created a network effect and locked in enterprise users, establishing the foundation for decades of growth. By the 1990s, Windows and Office had become ubiquitous. Companies and consumers alike depended on Microsoft software, creating an economic moat reinforced by the high switching costs associated with retraining, software compatibility, and data migration. The early 2000s brought challenges, including regulatory scrutiny and the rise of competitors. However, Microsoft's assets and customer relationships remained valuable. In 2014, Satya Nadella became CEO and refocused the company on cloud computing and AI. This pivot transformed Microsoft from a legacy software vendor into a cloud-first, AI-enabled company, positioning it for the next several decades. Microsoft's business can be divided into three major segments, each with distinct growth drivers, margins, and strategic importance. The Productivity and Business Processes segment includes Microsoft 365, Office Suite, LinkedIn, and Dynamics. According to the FY25 annual report, this segment generated approximately $120.8 billion in revenue, growing around 13% year-over-year. The recurring subscription model ensures predictable revenue streams, while enterprise adoption of Microsoft 365 has created high switching costs. LinkedIn's advertising, talent solutions, and premium subscriptions further enhance revenue visibility, making this segment both highly profitable and durable. The Intelligent Cloud segment is the company's primary growth engine. It includes Azure, server products, and enterprise services. In FY25, cloud revenue exceeded $106 billion, with Azure contributing roughly $75 billion and growing at approximately 30% year-over-year. Azure benefits from Microsoft's existing enterprise relationships, bundling cloud services with productivity software and leveraging economies of scale. Deferred revenue from long-term contracts further provides predictability in future earnings. While cloud services have lower margins than software licensing, the scale and recurring nature of contracts generate substantial free cash flow. The integration of AI services within Azure and enterprise applications enhances Microsoft's long-term strategic advantage. More personal computing, which includes Windows licensing, Xbox, Surface devices, and search advertising, contributes approximately $54.6 billion in revenue. Growth is slower and more cyclical, but this segment plays a strategic role in maintaining Microsoft's broad ecosystem. Gaming subscriptions, Xbox content, and the acquisition of Activision Blizzard increase recurring revenue and ecosystem stickiness, while Windows continues to anchor enterprise adoption. Surface and consumer hardware maintain Microsoft's presence in end-user computing. AI integration is now central to Microsoft's strategy. AI is embedded in Microsoft 365 through Copilot, in GitHub, and in Azure Cloud Services. These initiatives are not standalone revenue plays. They amplify existing cash flows and enhance enterprise dependency on Microsoft software. The FY25 annual report highlights significant AI-related capital expenditures, which support both cloud and productivity expansion. While these investments have temporarily pressured margins, they strengthen Microsoft's strategic position and future monetization potential. AI adoption scenarios suggest Microsoft's AI-related revenue could grow substantially in coming years, further reinforcing the company's competitive moat. From a financial perspective, Microsoft is exceptionally strong. FY25 total revenue reached approximately $281.7 billion, a 15% increase from the prior fiscal year, while net income exceeded $101 billion, representing roughly 16% year-over-year growth. Profit margins are among the highest in the industry. Net margin is 35.7%, operating margin is 48.9%, and return on equity is 32.2%. Free cash flow remains robust at around $53 billion, supported by $147 billion in operating cash flow, and cash equivalents exceed $102 billion. Debt levels are moderate, providing a fortress balance sheet, capable of sustaining strategic investment and shareholder returns. Microsoft's valuation reflects both its quality and growth potential. The company trades at a trailing PE of approximately 32 and a forward PE near 28.30. Price-to-sales ratios range from 11-13, reflecting market expectations for continued high growth. While multiples are elevated, they are justified by Microsoft's scale, recurring revenue, durable competitive advantages, and AI-driven growth potential. Analysts and investors should recognize that these metrics reflect expectations for future earnings, not speculation. Capital allocation is disciplined. Microsoft maintains a modest dividend yield of roughly 0.8%, with a payout ratio around 23%, ensuring sustainability and room for growth. Share repurchase programs total tens of billions annually, reflecting management's commitment to returning value to shareholders while investing in long-term strategic initiatives. This balance of dividends, buybacks, and reinvestment aligns closely with Buffett and Munger's principle of intelligent capital allocation. Risks remain, as no investment is without uncertainty. Cloud growth faces competition from AWS and Google Cloud, while AI execution requires sustained investment in infrastructure and adoption. Regulatory scrutiny and macroeconomic factors could impact enterprise IT spending. However, Microsoft's recurring revenue, diverse business lines, and strong balance sheet mitigate many of these risks. Even under stress, the company generates sufficient cash flow to fund dividends, buybacks, and strategic initiatives without compromising long-term growth. Long-term investors should focus on the underlying economics rather than short-term price fluctuations. Microsoft exemplifies the type of business Buffett and Munger favor: a durable franchise with predictable cash flows, strong competitive moats, disciplined management, and the capacity for long-term compounding. The premium valuation reflects expected future growth, particularly from cloud and AI. But the underlying business remains resilient and strategically positioned for decades. Microsoft is a multi-decade compounder. Its ecosystem of productivity software, cloud infrastructure, AI integration, and hardware creates a sticky revenue base that competitors struggle to replicate. Financial discipline, recurring cash flow, and capital allocation make it a model for long-term value creation. Premium valuation multiples are a reflection of market expectations for continued dominance rather than a signal of inherent risk in the business. For investors focused on long-term wealth creation, Microsoft represents a rare combination of quality, durability, and growth. Microsoft's journey from a garage startup to a global technology leader is a testament to strategic foresight, disciplined execution, and the power of entrenched business models. Its recurring revenue streams, dominant cloud and AI platforms, high margins, strong cash flow, and intelligent capital allocation make it a company worth understanding deeply. Long-term investors who evaluate Microsoft from the perspective of business quality, cash flow generation, and strategic positioning are likely to be rewarded, provided they maintain patience and focus on the economics of the business rather than short-term market movements. Microsoft's productivity and business processes segment continues to generate consistent revenue growth. Enterprise adoption of Microsoft 365 has expanded steadily, and LinkedIn monetization has contributed significantly to overall revenue. AI integration into Office 365 and Dynamics increases user dependency and adds value to Microsoft's ecosystem. This segment alone represents a recurring cash flow engine that is highly resistant to competitive disruption. The intelligent cloud segment underpins Microsoft's growth. Azure adoption has surged globally, capturing enterprise migrations and cloud-first strategies from multinational corporations. Azure's integration with AI platforms, such as Copilot and OpenAI services, allows Microsoft to differentiate itself from competitors. Long-term contracts and subscription models provide predictable revenue streams and enhance cash flow stability. Cloud revenue growth continues at impressive rates, even from a large base, which is rare for any company of Microsoft's scale. More personal computing remains strategically relevant, even if revenue growth is slower. Windows licensing maintains enterprise standards, Xbox gaming subscriptions drive recurring consumer revenue, and Surface devices provide brand visibility. Revenue from this segment is supported by acquisitions like Activision Blizzard, which strengthens gaming content offerings and ecosystem stickiness. Together, these initiatives maintain Microsoft's market relevance across both consumer and enterprise markets. AI initiatives extend Microsoft's moat by enhancing existing products. AI-driven features in productivity software, code generation tools, and enterprise analytics increased dependency on Microsoft platforms. The FY25 annual report details billions in AI infrastructure investments, demonstrating long-term strategic commitment. While these expenditures temporarily reduce margins, the strategic payoff positions Microsoft as a dominant AI provider integrated into critical enterprise and consumer workflows. Financial performance underscores Microsoft's quality. Revenue of $281.7 billion and net income of $101 billion in FY25 reflect the company's growth and profitability. Operating and net margins remain among the industry's highest, and return on equity is exceptional. Strong free cash flow supports strategic investments, dividends, and share repurchases. Capital allocation is disciplined and consistent with long-term shareholder value creation principles. Stock valuation reflects Microsoft's quality and growth expectations. Elevated multiples, such as a PE of, represent anticipated future earnings, primarily from cloud and AI initiatives. Price-to-sales ratios and PEG ratios indicate the market prices in Microsoft's durable competitive advantage and long-term earnings potential. While these multiples may appear high relative to historical averages, they are justified by the scale, profitability, and recurring revenue of the business. Microsoft balances dividends and share repurchases effectively. Dividend yields remain modest at ~0, 8%, but payouts are growing steadily. Share repurchase programs complement dividends, returning tens of billions annually to shareholders. Capital allocation aligns with long-term value creation, funding strategic investments in cloud and AI while rewarding shareholders, which aligns with Buffett and Munger's principles. Risks include cloud competition from AWS and Google, AI execution, regulatory scrutiny, and macroeconomic fluctuations impacting enterprise spending. Microsoft's scale, recurring revenue, and strong balance sheet mitigate many of these risks, supporting sustainable growth even in challenging market conditions. For long-term investors, Microsoft represents a durable, high-quality company capable of consistent earnings growth. Its competitive moats, recurring revenue, strategic investments in cloud and AI, disciplined capital allocation, and financial strength make it an exemplary long-term investment. Market valuation reflects anticipated growth, but the underlying business economics are sound and resilient. Patience and focus on business fundamentals are essential to realizing the full potential of Microsoft as a long-term wealth creator.